Very good evening to all of you. On behalf of Auditing and Assurance Standards Board of Institute of Chartered Accountants of India, I welcome you all in today's webinar that is on very important aspect, that is the 5 audit assertions, understanding and importance. And in order to tackle this very important topic for all our members, we are having with us very eminent, very learned, very respected C. Sandeep Dinodia ji. So on behalf of AASB of ICI, I extend my warm welcome to you, sir, on this AASB platform. Welcome to you, sir. Namaste. We are also having Madam with us. She is the coordinator for today's webinar, Madam Nandini ji. So I also welcome on behalf of AASB of ICI. Welcome, Nandini Madam, on this AASB platform. You are going to moderate today's webinar. So without wasting much more time, I request Nandini Madam to please start the proceedings of today's webinar. Over to you, Nandini Madam, please.
Good afternoon, everyone. I'm Nandini Agarwal, moderator for today's webinar organized by Auditing and Assurance Standard Board of ICI on the topic Audit Assertions, Understanding and Importance. Audit assertions are claims made by management about the accuracy and completeness of financial statements. The importance of audit assertions lies in the role in guiding auditors to test specific areas of the financial statement. By examining these assertions, auditor can gather evidence to support or challenge management's claim and form a reliable opinion on financial statements. In brief, auditor assertions help ensure that the audit is thorough, focused, and accurate, ultimately providing confidence to stakeholders in the financial reporting process. Now, I would like to introduce you to our guest speaker for the webinar, Mr. Sandeep Dinodia. He has completed his Bachelor of Commerce from Sri Ram College of Commerce, Delhi University in 1983, and his LLB also from Delhi University in 1986. He is FCA from Institute of Chartered Accountants of India since 1984. Mr. Dinodia is on the board of directors of many large public listed companies as an independent director, offering invaluable guidance on companies' policy of good corporate governance and help solving compliance issues with myriad of laws under SEBI, Companies Act, and FEMA, etc. In his capacity as assurance head of SRD, he has been involved in supervising statutory audit, internal audit, tax audit, due diligence audits, management audits, bank institutions, and large public and private sector companies for more than 35 years. It's a great honor for me to be introducing him today. Welcome, sir.
Thank you so much, Nandini, for that very flattering introduction. I don't know how much I deserve out of it, but thank you to the Auditing and Assurance Standard Board to invite me to speak on this very important audit assertions, understanding and importance. Though we have all been doing audit for a long time, sometimes we tend to forget what are the basic underlying principles of audit. And this seminar and webinar also gives me an opportunity to read through again what the various handbooks of the Institute and various guidance notes and standards in auditing have already told us, but we just have to recap things and refresh our memories. So it's like, you travel in an aircraft and they tell you that you have to fasten your seat belts. You all know that, but they still tell you that. So it's sometimes refreshing to understand these things again. And I must say, I've learned myself a lot while reading through these handbooks and the guidance notes of the Institute on audit assertions, and really benefited while preparing for this webinar. So I would like to now straight away dive into this topic, very interesting topic of audit assertions, which I think is very basic to auditing. And let's see where it leads us and what we understand from it. Let's work on it together. Today's presentation, I will go through what are assertions, transaction level assertions, account balance assertions, presentation and disclosure assertions, importance of auditing assertions, challenges in auditing assertions, and audit assertions in risk assessment. So this is the framework of my discussion today. And this is how we will navigate through this topic today. So what are assertions? This has been very clearly given in terms of a heading in the handbook on auditing pronouncements, SA 315. And it says that assertions stand for representations by the management, explicit or otherwise. So it could be explicit in writing, or it could be understood, or it could be indirectly the management gives us assertions which we are supposed to understand. So the word otherwise has been used here, that are embodied in the financial statements. So as we understand that once the audit financial statements are prepared by the management and we write in our audit report, it is the responsibility of the management to prepare the financial statements. When they hand it over to the auditor to audit those financial statements and give his report thereon, the management automatically makes certain explicit or implicit assertions to the auditor, which the auditor has to take into account and are used by the auditors to consider different types of potential misstatements that may occur in the financial statements that we are supposed to audit. So the assertions are what the management has told us, and we are planning our audit at the audit planning stage, trying to find what are the potential misstatements that could have occurred or is the possibility of occurring in the financial statements that are given to us to audit. The risk of material misstatements at this assertion level. So we are still at the assertion level where the management has asserted to us implicit or explicitly by giving us a financial statement for classes of transactions. So there are various classes of transactions of different kinds that have taken place: revenue, capital account, and otherwise. There are account balances that are there in, again, revenue, capital, assets, liabilities, and disclosures that the company and management have done in the financial statements that they've given to us to audit. And these disclosures need to be considered because such considerations directly assist in determining the nature, timing, and extent of audit procedures at the assertion level necessary to obtain sufficient and appropriate audit evidence. So what we are doing right now is we are trying to determine the nature, timing, and extent of our audit procedures. We are planning our audit. We are trying to find what kind of a nature of audit we have to do, how are the timing to be done of the audit, and what extent of audit procedures we should carry out. And this is at the assertion level where the management has asserted certain things to us, again, implicitly and implicitly, and which should provide us sufficient and appropriate audit evidence. Both words are very important: sufficient and appropriate audit evidence, based on which we will frame our final audit conclusion. In identifying and assessing risks of material mismanagement at a particular assertion level, the auditor may conclude that the identified risks of such assertion would be more pervasive, would have more pervasive impact on the financial statements as a whole and potentially affect many other assertions as well. So what this means is that one assertion can have a pervasive impact on other assertions or on the financial statements as a whole. And we will go into in depth what this means in my subsequent slides and presentations. But this is one of the aspects of planning of an audit at the assertion level, where I must look at how one assertion can affect other disclosures or even the financial impact on the financial statements. In representing that the financial statements are in accordance with the applicable financial reporting framework, the management implicitly or explicitly makes certain assertions regarding. Now, what are these assertions? They are regarding recognition of both revenues and expenditures, assets and liabilities, measurement, again, measurement of all these assets, liabilities, revenues and expenditures, presentation and disclosure of all these in the relevant format of various elements of the financial statements and related disclosures, which are required by Schedule 3, by regulatory framework, by accounting standards. So all these financial statements must comply with all the disclosure requirements that are required by the various laws. So assertions, there are three kinds of assertions: assertions about the class of transactions, assertions about the account balances, and presentation and disclosure assertions. This is what we just discussed. Now, transaction level assertions are utilized by the auditors while examining all accounting entries and transactions to ensure accuracy, completeness, and validity of financial information, and thereby to gain confidence on. So we are now talking about examining all accounting entries and what are the assertions, how will they help us to gain confidence on five things. These are the five benchmarks of the assertions which we have to keep in mind. And this is where our auditing planning comes into existence, is occurrence and existence of the transaction and events that have been recorded have actually occurred pertaining to the entity. So we have to first see whether all the transactions that are there in the financial statements have actually occurred and were in existence and have been recorded in the financial entity. The second is the completeness. All transactions and events that should have been recorded have been recorded. And there are no extra transactions, there are no less transactions. So the completeness of all transactions that pertain to the financial period under audit have been recorded. Related to that is, of course, cutoff procedures. The transactions and events have been recorded in the correct accounting period. Again, relating to completeness, that the cutoff procedure at the year end, cutoff procedure at the beginning of the year, events occurring after the balance sheet have all been considered while making the financial statements. Accuracy. Amounts and other data relating to recorded transactions and events have been recorded appropriately, which means accuracy of making the financial statements in terms of the figures that are accurately reported in the financial statements, along with the cutoff procedures, along with the completeness, along with the fact that they have occurred and are in existence. We have to also ensure the figures are correct and have been correctly reported. And last but not the least is the classification. The transactions have been classified under the proper heads and proper accounts. So if these five principles of auditing have been taken care of in the at the assertion level, then our auditing planning should go in these to ensure compliance with all these five. We are almost home, and we will ensure that the financial statements are free from any material error and they are true and fair. Now I will give some examples to try and explain these five very, very important aspects of transaction level assertions. The first, as I explained, was occurrence. I'll take the example that a company records a sale of 10,000 rupees to a customer on December 30th, 2024. The management asserts that this sale occurred on the basis of sale order, goods were shipped, and the customer is legitimate. So there are three things that when the management puts 10,000 rupees in its sales statement in the profit loss account, it has asserted to us directly or indirectly, that there was a sale order from the customer, the goods were actually produced or procured and shipped to the customer. That means the sale is complete under Sale of Goods Act. And the third, that the customer is a legitimate customer and the transaction is legitimately completed and reported in the books of accounts and properly reported in the financial statements of the company. So this first thing is the occurrence of that state of that transaction, and it is not that some sale has been booked which actually did not take place at all and is fictitious. So this is the first most important assertion that the management makes to us when it gives us a financial statement of occurrence. The auditor, what will the auditor do in this? The auditor will inspect the sale invoices, the shipping documents, and customer contracts to verify that the sale is valid and the goods or services were actually provided to the customer. So we have to see that based on the assertion, I have verified the invoice, the shipping document, the customer contract to see whether the sale services were actually provided to a customer. I'll give another example here. Sometimes there is the contract with a customer which is CIF, and the contract says that the sale will be completed when the customer accepts the quality and quantity of the goods at his own premises. In such a case, even though the sale invoice may have occurred, the shipping documents may have taken place, but the contract says that the sale will be completed only when the customer accepts the goods. So we will not book this as an occurrence of this period, and it will happen only when the occurrence of the acceptance of goods takes place, and the sale will then be complete. So this is one example where you can have three things in line, but the fourth, which comes out of the customer contract, takes the sale into the probably in the next accounting period or the next month, so that it is recorded based on that contract. The second important part of the assertions that the management does to us when it gives us a financial statement is the completeness. The company that has made a sale, for example, on 31st December 24, but forgot to record it in the books. The management asserts that all sales have been included in the financial statement. This is inherent assertion that the management makes to us, that all sales for the period under audit have been recorded, but it has forgotten to record one particular sale of one particular date. What will the auditor do? The auditor will perform such procedures such as reviewing the shipping logs, outward registers, matching them with sales revenue to ensure that all sales are recorded. So our job as an auditor is to ensure and have such procedures in our audit planning and an audit process to ensure that our process gives us full confidence that any sales which have actually occurred, or it could be a completeness, it could be sale, it could be an expenditure, it could be a capitalization, it could be a sale of a capital expenditure, have all been recorded, and we have to do audit procedures aligned with them to give us confidence on the completeness of the transactions in the financial statements. The third example that I want to share is on cutoff procedures. Again, if the company ships goods out on 31st December, but the risk and reward were transferred up to 5th January, and the financial statements are concluded, let's say if the accounting period is 31st December, then if the risk and reward are, like I gave the example earlier, if the contract says that the sale will be completed only when the customer accepts the goods, then the risk and reward are not transferred by 31st December, even though I've done the billing, I've done the production, I've done the shipping. So that sale will be included in the next accounting period. Let's say if the goods are approved on the 5th of January, they will be taken in the next accounting period of 5th of January and not on 31st December. So the cutoff procedures have to be applied on every 31st March, every reporting period, to ensure that these are correctly included or excluded from the financial statements. The fourth important part of the assertions level planning would be on accuracy. Here I'm taking a small example of suppose there's a sale of rupees 5,000 was made at a 10% discount and the applicable sales tax. The management asserts that the correct amount after applying the discount and the tax have been recorded in the books. This is the management assertion. The auditor in his audit procedures will test whether the recorded amount for each sale is correct by recalculating the transaction based on the terms, that is, the basic price, which is 5,000, the discount, which is 10%, and the applicable sales tax or GST that is applicable on those goods. Will recalculate on a sample basis the sales and will compare them with the actual amount shown in the financial statements and also examine the same with the contracts and sales agreements to ensure occurrence, completeness, and cutoff. So accuracy has to be read again with cutoff, completeness, and occurrence, the back 3 points that we discussed, to close the financial figure on the sales and ensure that the amounts are correctly and accurately depicted in the financial statements. The fifth would be classification. For example, a sale of inventory is mistakenly classified as other income instead of sale of revenue. This can happen if in some cases, suppose the company is engaged in the business of selling auto components, but also, which is very common, that they also make dies and fixtures for the customer and also sell the same, which are not the normal product of the company, but are infrequently made. These are sometimes categorized as other income of the company, as that is not the main business of the company to sell dies and molds and jigs, though those are used by the company for the customer to produce the goods itself. So the management asserts to us that all transactions are correctly classified in the proper account. The auditor in this case will review the general ledger and ensure that all sales transactions are classified correctly as revenue and are not misclassified into other categories like other revenue, like we just said, other income, and also review the nature of revenue and ensure that sales are distinguished from non-sale activities such as investment income and interest income. So what this also means that I must see the classification, that I don't merge investment income or interest income into the sales or operating income of the company, when those should be depicted as other revenue or other income of the company. So this classification, this is just one example of classification. There will be hundreds and thousands of other examples that the auditor has to ensure that the assertions given by the management at the level of giving the financial statements are then reviewed to ensure that correct classification is done and to point out if any classification is incorrect based on the nature of the business of the company. So these, friends, are the 5 pillars of assertion and the most important part of today's discussion. We now move on to account balance assertions. The account balance assertions are used to check the accuracy of the balance sheet items, including assets, liabilities, and equity totals. Again, here there are four aspects to this account balance assertions. The first being valuation and allocation. Assets, liabilities, and equity interests are included in the financial statement at the appropriate amounts, and any resulting valuations or allocation adjustments are appropriately recorded. So every balance sheet basically consists of three main items: assets, liabilities, and equity interests. And we have to ensure either in IGAAP or Ind AS that the values at which they are captured in the financial statements are correctly valued and are allocated, and the values are correctly allocated to the various assets, liabilities, and equity interests while preparing the balance sheet and the financial statements. Rights and obligations. The entity holds or controls the rights to assets and liabilities are obligations of the entity. So the financial statements must depict very clearly that the entity, if the entity holds rights to, suppose it holds rights to trademarks or some intangible assets, then these rights to assets, the right to use property, plant, and machinery, which we call in the olden terms rental. So these are right to use assets. All these are now properly categorized under IGAAP or Ind AS, whether they have to be right to use assets have to be capitalized now, as you know, have to be shown separately. So all these rights and obligations of the company are properly valued and depicted in the financial statements. Existence, making sure that the assets, liabilities, and equity balances actually exist. Prime example of this, we will take up examples in future also, in the next slides also, could be that all the assets and liabilities we have to make audit procedures aligned to the fact to, for example, age-old method is that we do a physical verification of inventory at the year end. We take account balance confirmations from creditors and debtors. All these are methods and audit procedures designed to ensure that all the assets, liabilities, and equity balances actually are given at figures which actually exist on the reporting date. Completeness. All assets, liabilities, and equity interests should have been actually recorded. So there should be nothing missed out or included extra while preparing the financial statements, which gives us completeness and closure of the financial statement in a complete manner. I will try to give some examples for all these four so that it is more clear. Valuation. The management asserts that the accounts receivable balance of rupees 5 lakh has been recorded at its net realizable value with appropriate allowance for doubtful accounts as on 31st December 24. This is an assertion that the management makes when it gives us the financial statement. Now, as an auditor, I will have to test this as assertion. The auditor will test whether the account receivable balance has been properly valued, which means I have to then involve reviewing the allowance of doubtful accounts, examining historical collection data, analyzing any accounts that are significantly overdue, to ensure proper provisioning of doubtful debtors or debtors which need to be written off has been done in the financial statements. So by this way, I am valuing a very big asset, which is a sundry debtor, at a correct value by making appropriate provisioning against the same or appropriate write-off of debtors that don't exist at all. So it could also be that the money has been already received from a particular debtor, but is not adjusted in the debtor's account, which is lying in as a credit balance, which is a very normal thing. So we need to have audit procedures designed to check whether any creditors are lying off the same debtor. So we need to adjust it against the debtor balance, or vice versa, that any debit balance lying off a creditor, which needs to be adjusted. So by making such adjustments, we are then valuing correctly the debtors and creditors of the company on a reporting date. The rights and obligations. The management asserts, another example of this rights and obligations would be that the management asserts that the company holds the legal right to collect an account receivable balance of 5 lakhs as on 31st December, and there are no undisclosed liens or other claims against these receivables. The auditor may review the contracts, agreements, or any other legal documentation to confirm that the company holds the rights to the receivables and no third party has any claim on them, including verification through obtaining confirmations. This also happens in a lot of cases that we think that the company has the right to receive a debtor, but the debtor has already issued debit notes for any claims or shortages or defective goods that they may have received, which have not been adjusted by the management in the debtors accounts or in the accounts of the financial statements, which makes the account receivable not receivable to that extent of the debit notes raised by them. So the rights and obligations of the company need to be properly evaluated to achieve the result of making a correct valuation of the assets and liabilities. The third aspect was existence. The management asserts that the account receivable balance of 5 lakhs as reported on 31st December represents valid amount due from the customer and exists on the balance sheet date. The process that the auditor normally does is either confirmation request to the customers to verify the amounts account receivables are valid and existed on reporting date. The auditor can also inspect supporting documents such as invoices and contracts, or also perform subsequent checks post the accounting date to see whether this amount has been received, and that in case we do not receive a confirmation, the auditor is fully empowered to do what procedures they call analytical procedures, analytical and substantive procedures in the subsequent date. Subsequent realization checking to ensure that this amount is in existence as on 31st of December 24. Completeness. The management asserts that all receivables due from the customers as on 31st December have been accurately recorded and included in the accounts receivable balance of rupees 5 lakhs. The auditor may perform cutoff test, review sales transactions near the end of the reporting period to ensure that all receivables that should be recorded are included in the financial statement. They may also reconcile subsidiary ledgers of the sales to the general ledger Along with this, we are also going to do the other procedures of existence, rights and obligations, valuation, to ensure that on the reporting date, there is completeness of all debtors which are there are reported as on 31st December 24. And this applies not only to debtors, it also applies to the creditors. It also applies to advances given for capital goods, advances given for uh, normal goods for manufacture or for trading. It applies to advances given to employees or any other parties for any other purposes, advances given for traveling to the employees, whether these still existed on the cutoff date, whether and they have subsequently been adjusted or not. So the completeness of all debit and credit balances must be ensured, and these are the assertions that the management makes at uh, at the time it gives us the financial statements before we start the audit, that the valuation is correct, the rights and obligations have been included, the assets and liabilities and equities existed as on the date of reporting, and this completeness of all information of assets, liabilities, incomes, and expenditures, and equity balances as on the reporting date. We now come to the next aspect of assertions, which is presentation and disclosure assertions. This is the third type of assertions used by the auditor, is the presentation and disclosure assertions, which can be applied both to transaction level assertions and account balance assertions. Here again, we will apply the four principles of accuracy and valuation, occurrence, classification and understanding, and completeness to the assertions by the management on the presentation and disclosure. The first one, example. I'll go straight away to the example which to understand the accuracy and valuation. The financial and other information are fairly disclosed at appropriate amounts. For example, it is asserted that the account receivable balance of 5,000 is accurately presented in the balance sheet. The allowance for doubtful debts, if any, is correctly stated at 25,000, and the net receivable amount of 4,75,000 is properly disclosed in the financial statement. Now, as you all know, the debtors balance has to be given in the buckets of more than 6 months, more than 1 year, 2 years, and 3 years. So that is the presentational requirement, which also needs to be given at the assertion level. The auditor's test. The auditors will check the amounts receivable, the allowance or doubtful debts that are correctly disclosed in the balance sheet, and the corresponding notes of accounts, which are the buckets of disclosure of the various aging of debtors that is done. Occurrence. The disclosed event and transactions and other matters have actually occurred and they pertain to the entity. So there are two aspects in occurrence. One is that these events did happen, and two, that these pertain to the entity under audit and hence must be included in the financial statements. Occurrence. It is asserted that rupees 1 lakh disclosed in the financial statement as sales revenue for the period ended 31st December 24 represents valid sales and the transaction actually took place. We discussed this earlier also. The auditor will review the supporting documents such as sales orders, shipping documents, customer contracts to confirm that the sale revenue disclosed in the financial statements represents a valid transaction of sales which did occur in this period and also pertains to the entity under audit whose figures are being audited. So both these occurrence and it pertains to entity have to be included in my audit planning procedures. The third aspect is classification and understanding. Financial information is appropriately presented and described, and disclosures are correctly expressed. It is assured by the management that all disclosures relating to the company's accounting policies, estimates, including those for account receivable, have been clearly presented in the notes to the financial statements to enable the users to understand the financial position and performance of the company. The auditor reviews the notes to the financial statements to ensure that all disclosures are clear and understandable. So these disclosures are required, as you all know, in the accounting policies, in the accounting policies of estimates, and we have to ensure that the classification of these accounting policies are clear and unambiguous, and our financial statements are prepared in line with these financial accounting notes that we have given. The fourth aspect is, of course, completeness. It is asserted by the management that for example, all related party transactions have been fully disclosed in the notes to financial statements as on the reporting date. This includes all receivables, payables to and from related parties, as well as any guarantees or commissions or commitments. So, in these days, this part of the audit has become extremely important because a lot of these related party transactions could be not appearing as a financial entry in the books. For example, a guarantee given by the company may not translate to a financial entry in the books, or commitments may not translate to a financial entry in the books to a related party or even a non-related party. So these have to be seen and correlated from contracts, contingent liability notes, and other places to ensure that these are all properly disclosed. We also need to get statements from all related parties directly to see whether they match with the related party transactions given by us in our financial statements to ensure completeness of information to be given in all aspects of the financial statements, RPT being one of them, one of the very important ones of them. The importance of assertions in auditing can never be underlined because everything is relating to assertions made by the management based on which we are framing our audit program and our audit procedures. The foundation for testing and framework for audit procedures are assertions. The assertions provide the framework for the auditors to design audit procedures and evaluate based on the procedures, evaluate all the evidence that we collect during the audit. Risk assessments. By understanding the assertion, the auditors can assess the risk of material misstatements. We examine the assertions, and based on assertions, we see what are the areas of risk. Are there areas of risk relating to revenue recognition? Are they relating to expenditure recognition? Are they relating to asset recognitions? Are they relating to liability recognition? Are they relating to provisioning? Are they relating to ensuring proper and adequate disclosure in the financial statements? All this are based on the assertions made by the management, and to ensure the auditors have to ensure that we assess the risk of any material misstatement in the financial statements. Regulatory compliance ensures the auditors must ensure that the financial statement comply with the accounting standards. Of course, this is mandatory as per the Companies Act and other applicable regulations. For example, whether the RPT is disclosed as per accounting standard, Companies Act, and other applicable reporting framework. So RPT I'm repeating again and again because RPT is a very important aspect of all disclosures now. And there are two kinds of disclosures in RPT that go. One is the summary kind of transaction, one is the party-wise transaction, and both have to reconcile. And you have to reconcile the RPT with the parties themselves. You have to apply cutoff procedures in them. You have to give proper disclosures in the financial statements. So this regulatory compliance of accounting standards and regulations is the must for the completion of a systematic and cohesive audit. The interrelationship between audit assertions, audit control environment, and risk assessment are interconnected components of the whole audit framework. So this is all these three together are components of an audit framework. Together, they provide a systematic approach to evaluating the reliability of financial reporting, ensuring compliance with accounting standards, and identifying and addressing areas of potential misstatement. Assertions validate the effectiveness of control that are focal point of risk assessment. So these assertions, they validate the effectiveness and control based on which our audit procedures are designed and are the focal point of risk assessment. Then when we are doing a risk assessment of the various aspects of the company and its financial statements, these assertions are a very major part of a decision-making process of the auditor. Slide, please. Challenges in auditing assertions. Auditing assertions play a crucial role in verifying the accuracy and reliability of financial statements. However, auditors face several challenges when testing these assertions. These challenges arise due to the complexity of financial data, management judgment, limitations in audit procedures, and inherent risk in audit process. Complexity of financial transactions. Challenge. The financial transactions can be highly intricate, especially in industries with complex financial instruments such as banking, insurance, or technology. Transactions involving foreign currency, derivatives, or multi-step arrangements may be difficult to evaluate and confirm. An example of this could be a company may have long-term derivative contracts in respect of foreign exchange receivables or payables. The complexity involved could be in respect of valuation and accuracy of the underlying contracts based on which these derivative foreign exchange contracts have been undertaken by the company under the FEMA rules. It would also be a complexity on how these derivative contracts are accounted for by the company in its financial statements, whether they go through OCI or it goes directly through the P&L account route, or the mark-to-market is recognized in every financial reporting procedure, or the mark-to-market goes through the OCI route. So the Ind AS also has a guidance, accounting standards have guidance on these, how to account for hedging contracts, how to account for foreign exchange receivables, how to do mark to market. So all these are accounting standards that need to be applied while presenting the financial statements, and which involve these complex transactions. And these complexities have to be taken into account when the auditors has to fully test the assertions like occurrence, accuracy, and completeness. All three have to be taken into account while completing the audit of the hedging transaction. In some such cases, the auditor can also use the work of an expert as per SA 620 in case he needs to take an opinion on any valuation of any hedging contract, any completion of a hedging contract, or any transaction of a hedging contract that need to be included in the financial statements. Challenges in auditing assertions. The first challenge I gave example of was on hedging contracts, which is a very important aspect. Of course, there is also on the new accounting standard on creating provision for doubtful debts, which is based on a ECL model. So these ECL modeling checking is also a very complex transaction. In right to use assets, there is a method of calculating the PPE of the right to use assets. So these are all complex models that in Ind AS have to be used for making the correct judgment and depiction, presentation, and ensuring accuracy of the information, which the auditor has to ensure that the assertion that the management makes is translated into based on the proper accounting standards and application of the proper accounting standard. Another challenge could be assertions relating to estimates such as doubtful debts, and very important one that we have faced in our firm is on warranty liabilities or asset impairments that are inherently subjective and depend on management's judgment. Auditor may face difficulty in assessing the reasonability of these estimates, especially when future outcomes are uncertain. For example, management estimates the allowance for doubtful accounts based on historical data, but the actual collectibility of receivables may vary, making it challenging for auditor to test the valuation of assertion. Other examples include provision for warranty, useful life of property, plant and equipment, etc. I may elaborate a little bit on warranty because this is again a very hot topic. In most companies which are giving warranty on its products, have to account for it over the period of warranty, and the actual warranty claim sometimes may be in variance to the historical warranty claim. For example, if you have a 5-year warranty, you may have a small warranty claim of 1 or 2% coming every year, and suddenly in the 5th year, you may have a large warranty claim suddenly of 5%. What does the auditor do in such a situation? Do you account for, as Supreme Court says that we have to do a warranty provision on a scientific basis? Do we average out all the last 5 years, or we take the highest warranty claim provision based on the last highest warranty claim done against the company, or we take the smallest, or we take an average? So these are issues of valuation of expenditure of warranty, which needs to be taken scientifically. And here the assertion of the management on what kind of warranty claims are likely in future becomes a little uncertain, because future is uncertain always. You don't know what's going to happen. but we still need to have a reasonable provision of warranty to ensure a true and fair view of the financial results of the company and ensure that the management estimates and judgments and assertions in this behalf are reasonable. The impact. The auditors face challenges in evaluating whether the management estimates are reasonable, making it difficult to validate assertions like valuation, completeness, and accuracy. So again, the three pillars of the assertions, the valuation, completeness, and accuracy have to be applied to the provision of warranty, have to be applied to useful life of plant and equipment, have to be applied to ensuring that the provisioning for doubtful debts are correctly done under ECL model. The third challenge that the auditor faces is on data integrity and completeness. Auditors often rely on data from the management's internal system, example, ERP system or accounting software. However, if these systems are not functioning properly, or if there are issues such as incomplete data or missing records, it can impact the validity of the completeness and accuracy of the assertions. For example, if a company's ERP system fails to set off the invoices and payments in aging buckets, resulting in incorrect aging report, and thereby the analysis by the auditor becomes extremely difficult. And not only that, the presentation in the financial statements, which is required as per accounting standards and Schedule 3, becomes erroneous. In large companies, it is very difficult to manually calculate this data on the year end. So we have to ensure that the logic of the ERP system, the accounting software, is such that it gives out accurate information, which helps the auditor in ensuring that the assertions made by the management on the accuracy and completeness of the data given can be relied upon. The impact of this is that auditor may struggle to obtain complete and accurate picture of financial transactions, which can affect the overall completeness, accuracy, and classification of the assertions that are given by the management. Number 4 would be the fraud risk and management override. Fraudulent activities or management override, they're two different things. A fraudulent activity occurs and we come to know during the course of the audit through a whistleblower or a fraud the management has reported under the Companies Act, or the management reports to the auditor in its assertion that a fraud has occurred during the year. Then we have to design our audit procedures accordingly to do a deep dive into the areas where the fraud has occurred or a potential fraud could occur. The audit procedure should also look at a very important aspect which can give the auditor confidence on the assertions, is where management override of controls can lead to a misstatement or omission in the financial statements. Even with robust audit procedures, a fraud may not be very easily detected, especially when the management is involved in manipulating the financial data. For example, a management may intentionally misclassify expenses as capital expenditures to inflate assets, or vice versa, to deflate profits by writing off capital expenditures in the P&L account. Both these situations where an item of capital is treated as revenue or revenue is treated as capital completely distorts the financial information on the reporting date in terms of assets, in terms of incomes, in terms of expenditures, and the profits. So this aspect of ensuring correct classification of expenditures and under capital or revenue is a very important assertion by the management, and is different from a normal manufacturing auto component company to another company which is in real estate could have a different way of capitalizing expenditures or taking into capital work in progress. So it depends on the nature of business of each company on how we view capital or revenue expenditures. The impact, of course, is this introduces a significant risk to multiple assertions, including occurrence, completeness, classification, and accuracy, as fraud can distort financial data in ways that are not immediately apparent. Management override, of course, can be verified through journal entry testing to see where the management has put in a journal entry after the normal entries are passed. We could also check a management override entry on a holiday, on a Sunday, or on a gazetted holiday. If entries are put, then they can also be indicative that there is a management override on transactions, which could lead to a misclassification of expenditures or giving an incorrect picture of the financial statements. We all know that the audit relies on a sampling basis. It is not possible for any auditor to do a 100% check of all transactions. This sampling techniques are employed by the auditor to test the assertions given by the management and need to be planned at the beginning of the audit. However, sampling inherently comes with a limitation, as it may not always be representative of the entire population of transactions or balances. So we may miss out. For example, if an auditor selects a sample of invoices to test accuracy, there is a risk that a sample does not capture a misstatement that could exist in the unsampled transactions. This is an inherent risk of sampling, which we cannot avoid. So to mitigate the risk of this unsampled transaction missing out, and we have to the only way out is to ensure the accuracy, completeness, and occurrence. The auditor can use analytical procedures of testing as per SA 520, and through this analytical procedures can have some confidence over the overall transactions of the company, and to ensure that the unsampled transactions do not lead to any material misstatement in the financial statements. Much time.
So should I interrupt and ask a few questions from the audience? Yes. 1 second. So one of our audience wants to know whether assertions and management representations are same or different.
So assertions are given at the initial level, and the management representations are normally given at the year end when the audit is complete. And assertions are given along with the management financial statements. As I said, that once the financial statements are given, they accompany the assertions, and the assertions are inbuilt and inherent in the management financial statement itself. The representations that the management gives are finally designed based on the audit procedures that the auditor goes through, and at the end of the audit, the management will give management representation and not at the beginning of the audit.
That was insightful. And the second question is level of reliance on the figures audited by another branch auditor. How much can we rely on those figures?
So a branch auditor, again, the NAFRA these days has come out with a new amendment to SA 600 and has said that the reliance, you can rely on them, but ultimate responsibility of the financial statements still remains on the main statutory auditor of the company. So the branch, you can think of it like this, that the branch auditor is only helping you in your audit. So you don't have to do a deep dive into the branch audit itself, but you must ask the branch auditor all the relevant questions as if it was your own team. That's what we do in our firm, that we design questions for the branch auditor as if it was my own team auditing. And if I do my quality control procedures and SQC procedures on my own audit team, I will apply the same to the branch auditor to ensure that I have confidence that they have done the audit in the same manner as if I was there and doing the audit. And then based on the answers that I received, then I have the liberty to then go and check on a selective basis some areas which I feel need further check.
That was helpful. Thank you.
Should I go ahead?
Most definitely.
Okay. So these assertions are a subset of the overall risk-based audit approach. Now, this risk-based audit approach is based on identification of a risk of misstatement, whether due to error or fraud at the financial statement and assertion level. That's the first part, that I must try and identify what are the various kind of risks of material misstatement that can be there due to fraud or error, both fraud or errors. So fraud could be management related fraud, could be an unrelated fraud, or an error which could be due to an ERP default or error due to classification, as we discussed earlier, completeness, classification, and other occurrence, accuracy, cutoff procedures. All these are various errors that can happen. So these are risk-based approach that we must assess at the assertion level at the start of the audit. Then we must understand the most important part based on which the audit procedures are designed are the internal control process of the company, the control environment in which it operates, the control activities that the company undertakes, the information and communication between the various verticals of the company and the management, the monitoring of the various transactions of various departments, could be HR, could be purchases, could be capitalization, could be inventory, could be any aspect, could be hedging, could be foreign exchange reserves, could be sales, could be purchase orders. So the monitoring and risk assessment of all these areas must be done, which will give the auditor an understanding of the entity, its environment, including the entity's internal controls. So if the internal controls are robust and have operated well throughout the year, the auditor's risk-based approach we can design with a lower risk and lesser sampling check. If you find that these internal controls have not operated in a proper manner, then of course, in various areas of risk, you have to identify and then increase your level of checking. This risk-based approach provides a basis for designing and implementing responses of the assessed risk of material misstatement, which will help the auditor to reduce audit risk to acceptably lower level. So we must design our processes to ensure that the audit risk is the acceptable level. of course, this is linked to the calculation, though today is not topic is not there, but we have to link this to the calculation of materiality, that what level of materiality we are saying the 2-3 kinds of materiality that are there for the larger, smaller, and the trivial materiality, based on which we will assess the risk of the company, which are based again on internal control. So they're all interlinked to each other, which will help the auditor reduce the overall audit risk to acceptably lower level, which means I must reach a level where I'm signing off a balance sheet and I am giving an assurance to the reader of the financial statements that yes, the statements are free from any material misstatement and are complete, accurate, and with complete existence of correct classification. Understanding of the entity and environment includes as I've already explained that earlier in the earlier slides, that the auditor shall obtain understanding of the following: the entity's objectives and strategies, and those of the business risk that may result in material misstatement. So the first, everybody say that when you go to a new audit, first go and understand the business, understand how the business is being run, put yourself in the shoes of the management to understand what are his objectives, what are the strategies he follows, and based on that, what risk does he take in the business. For example, a company we have to see what is the nature of its operation. Does it operate in a single environment? It operates in a multi-country environment. It operates in a multi-state environment. It operates in a risky environment. Does it operate a mine, or it operates a manufacturing operation? The ownership and governance structure, is it are they divorced from each other? Is the company being run by a professional management and the ownership is divorced? The actual running of the company, is it a board run company, or is it run by the promoters and owners themselves? The investment that the entity is making as well as planning to make in future, does that affect the operations of the company in any manner? The financial structure of the company, is it robust, or is it too skewed towards debt? Is the financial structure leading to, if the company is a listed company, if there are wide fluctuations in the share prices for any reason, which means that the investor community is also a very major stakeholder in the company. And do they look at the company in a manner that the company has some risk involved in it? The measure and review of entities' financial performance, relevant regulatory and other external factors, including applicable framework, whether special purpose financial statements, applicable gap requirements, if they are stockbrokers and their stockbrokers disclosure requirements, if they are NBFCs, insurance or banking companies, then all three of them have special requirements of disclosure and classifications and accounting policies that they need to follow. So these all become very complicated, and we have to ensure that all the applicable regulatory requirements of the entity are being fulfilled, and ensuring that at the assurance level itself, they are giving us some details about how the company is operating and what are the risk environment in which they're operating. Selection and application of accounting policies, including the reason for changes thereto, if any. For the above mentioned purpose, the auditor shall identify risks throughout the process of obtaining an understanding of the entity and its environment, including relevant controls. Assess the identified risk and evaluate whether they exist pervasively in the financial statement as a whole and potentially affect any assertions. Example, whether sales return should be netted off from sales during the year or adjusted against the provision for warranty. These are very important aspects. Just one example of how to evaluate the risk that the company's financial statements can have. Relate the identified risk to what can go wrong at the assertion level. Consider the likelihood of misstatement, including possibility of material misstatement and whether the misstatement is of magnitude that could result in material misstatement in the financial statements. So we have to consider the possibility that where the misstatements occur, what are the risk of the misstatement, and how large these misstatements can be. How would they affect? Are they below the materiality level? They're above the materiality level? Would they are they so critical that we have to design our audit processes along with it? So the assertions now are to be evaluated based on the risk environment of the company, and only then we can design our audit procedures along with it. A misstatement and possible sources. SA 450 defines the meaning of misstatement as a difference between the amounts, classification, presentation, or disclosure of reported items. So there are three things: that the amount has to be accurate for a misstatement or inaccurate, the classification and presentation has to be correct, and disclosure of the reported items compared to what is required is in accordance with the applicable financial reporting framework. Now, this misstatement may result from an inaccuracy in gathering or processing data from which the financial statements are prepared. This inaccuracy can result from, like we said earlier, in the ERP system of the company itself, or from the environment in which it operates, or from a fraud, or from error in application of accounting standards, or an error in accounting policy of the company. So all these could result in inaccuracy in gathering and processing of data from which the financial statements are prepared. There could also be an omission of an amount that has occurred in the financial statement and is omitted from the financial statement. An omission of disclosure could also happen, which is required to be disclosed, and we miss out doing a disclosure in the financial statement. An incorrect accounting estimate. Accounting estimates are on could be on gratuity, on estimated life of an asset, could be on warranty, could be on debtors, could be on creditors, could be on valuation of assets for investments in subsidiaries and associates, or selection of inappropriate accounting policies. So we could have taken an accounting policy which is not as per accounting standards, or is not in line with the risk environment in which the company operates. These all five aspects could lead to a misstatement in the financial statements, and these could lead to a incorrect financial reporting framework. I would like to give some examples and events that may indicate the risk of material misstatement. The following are examples and conditions of events that may indicate the existence of risk of material misstatement that could impact different assertions. The examples provided cover broad range of conditions and events. However, not all conditions and events are relevant to every audit engagement, and the list of examples is not necessarily complete. Operations in regions that are economically unstable, for example, countries with significant currency devaluations or highly inflationary economies. If in such economies we have subsidiaries or joint ventures operating and they are consolidated with the main parent company, it could lead to impact on the financial assertions of the company. Operations exposed to volatile markets, for example, futures trading, stockbrokers, hedging contracts, hedging in foreign exchange, large dependence on foreign exchange from countries where fluctuating currencies values are there. These could lead to a material misstatement and assertions. Going concern and liquidity issues, including loss of significant customers, could also lead to an issue on going concern. Constraints on availability of capital and credit, regulatory changes in the industry in which the entity operates, a change in regulatory environment of the industry. For example, if there could be a change in if a company operates in as an automobile manufacturer, and there's a change in the pollution norms, and it could make some part of the business of the company redundant, is not following the operation of the pollution norms. Or if the industry is going towards EV, and the company is engaged in a business which is more skewed towards fossil fuel, then the long-term view could be that the company is not in a stable business environment and could lead to losses in future, and could lead to a risky environment for the company itself. Developing or offering new products or services or moving into new lines of business is always risky. As we say, no pain, no risk, no gain. So, but still, companies, when they go into new businesses, there's always a new risk involved, whether the new business will be successful or not. And once you commit large amount of capital to a new business, then of course your capital comes under strain. Regulations or large acquisitions or other unusual events. This is again a very normal thing that businesses acquire other businesses or merge with other businesses, and then there is sometimes there is a difference in philosophy. Business in the companies take time to adjust to each other's environment, and sometimes products are not cohesive to the market. So these reorganization and large acquisitions sometimes lead to losses, or they could also lead to huge profits. But that's the risk that the businessman takes. Entities or businesses segments that are likely to be sold. So if you have any business segments which you are holding for disposal, then proper disclosure of that needs to be done in the financial statements. The use of off-balance sheet finance, special purpose entities, and other complex financing arrangements, these need again proper disclosure in the financial statements and have the risk of material misstatement. Significant transactions with related parties, as we have already discussed earlier, are very important and need to be properly seen during the course of the audit. Changes in key personnel, including departure of key executives, could be indicative of risk at material misstatement level, at assurance level, but this could lead to incorrect preparation of financial statement if the key executives and people who have a lot of experience in the company in preparing financial statements suddenly leave the company. The new people may not be able to cope with ensuring that all the aspects of occurrence, completeness, accuracy, cutoff, and classification, adherence to the regulatory environments are all in line for the financial statements. Sometimes the departure of key executives leads to a tricky situation and could lead to a risk of material misstatement. S315, we have been talking about, but assertions at the initial level by the management, and all these are basically covered by SA315 that defines significant risk as a identified and assess risk of material misstatement that an auditor's professional judgment requires special audit consideration. The auditor shall consider at least two following parameters: whether the risk is a risk of fraud, whether the risk is related to recent changes in any significant accounting or regulatory requirements, whether special purpose financial statements applicable gap, stockbrokers, NBFCs, NBFC, insurance, etc. are applicable. The complexity of transaction, example, cross-border transaction with layered subsidiaries, whether the risk involves significant related party transaction, example, establishing arm's length value in respect of proprietary transactions with related party is a risk. Significant transactions that are outside the normal course of entity or otherwise appear to be unusual. Example, slum sale or restructuring, including demerger or merger. The degree of subjectivity involved in measurement of financial information, example, accounting estimates in respect of useful life of PPE by management, tools, jigs, and fixtures whose life is different from the base machinery. Using assertions in risk assessment. Assertions can be used by the auditor in assessing risk at the financial statement level and assertion level. At the financial statement level, the risk of material misstatement tend to be pervasive, and therefore we should address all the assertions. For example, if the top accountant is not competent enough for the assigned task, it is quite possible that errors could occur in the overall financial statements. However, the nature of such errors will not often be confined to a single account balance, transactions, stream, or disclosure. In addition, the errors will not likely be confined to a single assertion, such as completeness of sales. It could just as well relate to other assertions such as accuracy, existence, and valuation. So what we are trying to say is a incorrect assertion at one level could have a cascading effect to other assertions in other parts of the company's financial statements in terms of accuracy, existence, and valuations, and not be related to only sales. It could affect your statutory disclosures, GST disclosure, inventory disclosure, related party disclosure, debtor disclosure, creditor disclosure. So one incomplete disclosure in sales can lead to a large number of incorrect disclosures which are pervasive throughout the organization. At the assertion level, risk relate to individual account balances at a point of time, that is, at the period end, the classes of transactions for the physical period, and presentation and disclosure in the financial statement. Pervasive risks and address all assertions are assessed at the financial statement level. The relevance of each assertion to an individual account balance or class of transaction or presentation and disclosure will vary based on characteristics of the balance and the potential risk of material misstatement. For example, when considering valuation assertion, the auditor should assess the risk of error in payables as low. However, for inventory where obsolescence factor is high, the auditor could assess the valuation as high. Another example could be valuation of investments in subsidiaries, joint venture, associates, and evaluating necessity of provisions at year-end. SA 315 defines risk assessment procedures as audit procedures performed by the auditor to obtain an understanding of the entity and its environment, including the entity's internal controls, to identify and assess the risk of material mistake. I think this line actually summarizes all the discussion that we have done till now. I would like to repeat this line. SA 315 defines risk assessment procedures and audit procedures performed by an auditor to obtain an understanding of the entity and its environment, including entities' internal controls. So you have to understand the entity's environment, including its internal controls, to identify and assess the risk of material misstatement, whether due to fraud or error at the financial statement level and at assertion level. The risk assessment procedures include following activities: observation, inspection, inquiry, discussion with engagement team, and analytical procedures. The engagement partner shall consider information obtained on his other audit engagements too, if relevant, to assess the risk of material misstatement and then planning procedures for verifying assertions attached to the risk. I think that's a repetition of what we've already discussed. And this is a reference material that we have referred to is SA 315, SA 450, SA 240, an implementation guide to risk-based audit of financial statement, which I think is the most important out of these, and they're all given on the Institute's website. Thank you so much.
It was a very insightful session, I must say. I have a few questions. So in what way do assertions influence the audit strategy and the scope of audit testing?
Sorry, can you repeat this question?
In what ways do audit assertions influence the audit strategy and the scope of audit testing?
So audit assertions are actually the basis on which you will make your audit strategy. And I think the whole discussion that we have had today is on finding what are the risk environment in which the entity is operating. Based on that, we will assess what are the internal controls that the entity has. We will then assess how are the controls operating in that company. We will, based on that, make our audit program and also do our sampling. And the percentage of sampling is, of course, relating to calculation of materiality level. So materiality level comes into a very important part of audit planning. So assertion level is assertions given by the company and materiality level combined give us the guidance on how we should go forward with an audit plan.
And the second question is, what impact does the failure to properly evaluate audit assertions have on an audit opinion?
Difficult question to answer. So, so if you have not evaluated all the audit assertions, and because of that, you give an audit opinion which does not highlight the misstatements in the financial statement, then you are failing in your job as an auditor, of course.
That was very helpful, sir. I must say it was a very refreshing session with you, and it was my honor to share this platform with you and able to meet you. And it was very knowledgeable, although it was a very basic topic, but you, with your like so simple examples, you made it more exciting and knowledgeable for all of us. Thank you so much for being part of it.
Thank you so much for inviting me today. Thank you.
Thank you so much, sir. Thank you so much, madam. As Nandini madam rightly said, as it is a very basic topic, but again, if we say it is a most important topic for all of us to know the assertions which are required, and you have covered all the aspects relating to all these 5 parameters, sir. So thank you so much from the core of my heart, as well as on behalf of AASB of ICI, for sparing your valuable time and sharing your insights with all our members, in spite of having your very busy schedule, as well as so many meetings. You have given your kind consent today for the sake of our members. So thank you so much once again, sir, for such a knowledgeable deliberation, sir. Thank you so much, sir.
Thank you so much.
Thank you, sir. Thank you so much, ma'am, for your wonderful coordination. Thank you so much. I also thanks all the participants also for your patientful hearing, as well as for joining the webinar. Thank you so much, everyone. Thank you.
Thank you.